Good morning, this is Mrs. Klett, and we're going to go over your investment strategies and all that kind of stuff for your test today on investing. That is NEFE Module 4. You need to be able to match up definitions and terms. Those terms are asset, compounding, diversification, dollar cost averaging, rate of return, savings account, stock, stock exchange, time value of money, and windfall. So be sure that you know your definitions. And the next section is multiple choice. So what is the time value of money? Tell me a definition of the time value of money. Time and money, that's all that's involved in this question. A very simple way is $1 today is worth more than $1 tomorrow. That's because of inflation, but that's what it is. You need to know that 3% is the historical long-term average rate of inflation. What type of option would you invest in to grow at a rate higher than inflation? Now you know that your savings accounts and your savings bonds, usually even real estate, pretty much stays at the inflation level. So what would you, pardon me, it's early in the morning, what would you invest in that would grow in a rate higher than inflation? If you want to start a mutual fund, to make the most money, would you start early and invest little bit by little bit by little bit to come up with the same amount if you saved up and just invested at a lump sum of time at a later date? So would the earlier investor make more or the later investor make more, and why? If you had the same principal amount and the same interest rate, I'm going to give you several options and you have to tell me which one would earn the most over 3 years' time. So would they all earn the same amount of interest? No, because your different types, your CDs earn more, especially if they're compounded daily. Compounded daily always earns more over time than compounded quarterly or annually. That's because you have that little bit of principal added every single day. Let it make money for you. Golly, don't let it sit in a drawer. Okay. A basic rule of risk to return relationship. Is it the lower the risk, the higher the return rate? No. Is it the higher the risk, the lower the return rate? No, those are both backwards. How about the higher the risk, the higher the return rate, normally? If you don't want to take much risk with your money, where would you put your money? If you put it in something, but you're really concerned about the risk, where would you put it? Not under your mattress. So if you had some extra money, like from a raise or something, a windfall that you hadn't counted on, what would you invest in to get the highest amount back? And you're taking a high risk. So this is opposite of the other question. Where would you put it with the highest risk? Tell me all about mutual funds. What they include, what's different about them, why they might be good, why they might not be good. Now, you do need to know that investing is buying something that's going to make you money. Okay? You can buy stocks and bonds, you can buy collectibles, you can buy whatever. Now give me an example of something that you buy that is not making you it's not investing. Say if you bought a car to get you to and from work, would that be investing? Now the work makes you money, but would buying the car actually make you money? But if you bought a business like an ice cream shop, would that be investing to make you money? If you invested in that shop? So think about those things. Which would be a real investment? Okay. You need to be able to rank investments highest to lowest with their potential for return. So you need to be very familiar with like mutual funds, CDs, money market, startup stock for a new company, U.S. savings bonds. Which one is the riskiest? Which one has the highest potential for return? Forget risky. Highest potential for return. And then take those same things and include collectibles, corporate bond, the stock in one company. You need to be able to rate the risk of the investments. Now the first one was potential for return. This is the opposite. This is the risk. Usually the higher the risk, the higher the return. So this one flips it on you. If you buy stock, do you share ownership in that company? And can you make day-to-day decisions in that company? Give me 3 steps to help build wealth. Do minors have to wait until they are adults before they can buy stocks and bonds? Can parents and guardians sign for them until they're 18? When is the best time to start investing? Hint, this takes advantage of compounding interest and any reinvestment of your earnings. So when should you start investing? If you are under 18, can you invest in a retirement fund if your company offers that? Sure you can. Yeah, and you should. How have most wealthy people gained their fortunes? Did they win the lottery? Did they inherit a large sum? Or did they plan, invest, and accumulate assets of value? Okay. Let's keep going. These I need you to write me short essays on. I need examples of the difference between saving and investing. You need to define that for me. Which is which? Saving is what, and versus investing is what? Why would you save money in a bank or credit union instead of hiding it in an envelope in your room, or hiding it in an envelope in your room under the mattress? So I need at least 2 reasons. Once again, you need to be able to calculate both the compound interest formula and the simple interest formula, which means you need to know those formulas. Okay? Now, one of the questions you will be given the initials TWTR. And I'm going to give you 5 elements of that, and you have to tell me what they are. NYSE, this is one of the elements. What does that stand for? The TWTR that I told you about, that's the account, and what does that stand for? And will have a bid price, an ask price, and a last price. And you need to tell me the difference between bid, ask, and last. I need 2 reasons why experts recommend diversifying investments. Why would you diversify? That means not having all your eggs in one basket. You would not put everything in one place. Why would you diversify? And what are a couple of other investing practices besides diversification? I need a couple of strategies that a new investor should avoid when he invests. And I need you to be able to explain to me the dollar averaging strategy, either in words, or you can use an example. So you can add, subtract, whatever. You can use numbers to explain that to me, but I need a very clear explanation of the dollar cost investing strategy. And that's it. Have a good time, and good luck. Prayers over all of you. God bless you. Bye.